Breaking news: gold, Forex, China, and global politics shape markets amid dire hunger crisis forecast for Nigeria. In today's major financial and socio-economic recap, we cover the key drivers behind market movements and their potential ripple effects on global and local economies. From gold's fluctuating price influenced by U.S. economic data to a record Forex turnover in Nigeria, these stories carry profound implications. We also take a look at China's recent consumer price slowdown despite massive stimulus efforts, how a Trump electoral victory has affected global credit markets, and the sobering forecast of a hunger crisis set to impact over 33 million Nigerians by 2025. Stick with us as we break down the numbers, the narratives, and what they mean for you. Gold Market Weekly Recap: Fed and inflation figures move prices. This week has been a roller coaster for the gold market, with a series of pivotal events setting the tone for price fluctuations. The Federal Reserve's recent statements, along with U.S. inflation metrics, specifically the Consumer Price Index, CPI, and Producer Price Index, PPI, have played a critical role in determining investor sentiment towards gold. After a brief surge, gold prices have settled down at approximately $1,920 per ounce, with traders eyeing the Fed's next move for more clarity on long-term price directions. The CPI, an essential measure of consumer inflation, showed a slight uptick, suggesting that inflation pressures may persist longer than initially expected. Such data is key in influencing the Fed's stance on interest rates. Higher rates often mean lower demand for gold as they make bonds and other interest-yielding investments more attractive. On the other hand, an unexpected drop in the PPI hinted at a possible easing in supply chain pressures, which is generally favorable for gold as a hedge against inflation. Another critical element has been the US dollar's strength, which usually runs inversely to gold prices. A firmer dollar tends to push gold prices lower, as it becomes more expensive for foreign investors to buy. While the dollar has remained robust due to rising yields, uncertainties over potential recession risks and global economic challenges keep gold as a preferred safe haven asset. Investors are now closely watching the next set of economic releases and the Fed statements to gauge what lies ahead for the yellow metal. Forex surge in Nigeria: highest ever daily turnover. The Nigerian foreign exchange market has experienced a record-breaking moment, with daily Forex turnover reaching an unprecedented $1.4 billion. This surge comes on the back of increased activity on the Nigerian Autonomous Foreign Exchange Market, NAFEM, fueled by high liquidity and rising confidence in the market. The surge also coincides with a rise in Nigeria's external reserves, now standing at $40 billion, providing the country with a much-needed buffer to stabilize its economy amidst global uncertainties. Market analysts attribute this surge in Forex turnover to the Central Bank of Nigeria's, CBN, policy adjustments aimed at liberalizing the Forex market. These policies include easing Forex restrictions and allowing a more market-determined exchange rate. The result? A more competitive market, encouraging both local and foreign investors to participate more actively, thereby boosting turnover. However, while increased Forex activity is a positive sign, the sustainability of this momentum is uncertain. Many factors could influence future movements, such as global oil prices, fiscal policies, and domestic economic stability. Rising reserves provide optimism, but economic experts caution that maintaining this position requires a continued focus on reforms, diversification of revenue sources, and efficient management of Forex inflows. The increased Forex turnover also brings implications for businesses and consumers. A more liquid and stable Forex market could help reduce exchange rate volatility, providing businesses with greater certainty in planning and imports, while reducing costs associated with currency fluctuation risks. This could ultimately translate into more stable prices for imported goods and services. China's consumer prices slowed despite stimulus. In an unexpected development, China's consumer prices have risen at their slowest pace in 4 months, even amidst significant stimulus measures designed to boost economic activity. The Consumer Price Index, which rose at just 0.5% in October, highlights ongoing struggles in consumer demand, suggesting that the world's second-largest economy may need further intervention to avoid stagnation. Despite measures such as interest rate cuts and subsidies, consumer spending remains below expectations, signaling weak economic confidence. The slow pace of consumer price growth comes as a surprise given the government's multi-billion-dollar stimulus packages, including infrastructure projects and tax breaks for consumers. Analysts believe that ongoing challenges, such as a struggling property market and lack of consumer confidence, are major contributors to this weak inflation figure. The Chinese government is now faced with the challenge of balancing stimulus to spur growth without exacerbating long-term debt. For the global economy, this situation presents both risks and opportunities. On the one hand, a slow-growing Chinese economy can weaken global demand for raw materials and manufactured goods. On the other hand, low inflation could encourage the Chinese government to maintain lower interest rates for longer, providing opportunities for international trade and investment. Businesses around the world are closely watching these indicators, as any major shift in China's economic policy can have far-reaching consequences. Trump win drives demand for credit as spreads tighten. A recent electoral victory for Donald Trump has triggered increased demand for credit, pushing spreads to their lowest levels since 1998. Investors seem to be betting that a Trump presidency would lead to a business-friendly environment characterized by lower taxes and deregulation. The immediate effect has been an increased appetite for corporate bonds, leading to narrowing spreads and cheaper borrowing costs for companies looking to raise capital. The credit market's reaction underscores a return of investor confidence, as businesses are expected to thrive under Trump's policies that favor economic expansion. The lower spreads, the difference between the yields on corporate bonds and government securities, mean that corporations can secure funding at much lower costs, a situation reminiscent of the late 1990s boom. Such conditions are favorable for expanding businesses, capital investments, and potentially for creating jobs. However, some analysts caution that this increased appetite for risk could create vulnerabilities. The narrowing spreads could mean that investors are underestimating the potential risks associated with corporate debt, especially in sectors with high leverage. If Trump's policies lead to economic imbalances or unforeseen disruptions, the credit market could face increased default risks. Nonetheless, for now, the boost in credit demand is seen as a positive signal for growth and stability in financial markets. Hunger crisis forecast, dire warning for Nigeria. A new report has delivered a grim forecast for Nigeria, predicting that by 2025, a hunger crisis could affect as many as 33.1 million Nigerians. The report attributes this looming crisis to several compounding factors, including widespread poverty, climate change, and continued instability in the agricultural sector. With over 15% of the population potentially at risk, the crisis could become one of the most significant humanitarian issues facing the country in the coming years. Food security has been a long-standing issue in Nigeria, exacerbated by persistent conflicts in the northern regions, which are critical for agricultural production. The combination of climate impacts such as flooding and desertification, along with inadequate government support for farmers, has reduced food production capabilities. With inflation making essential food items more expensive, the most vulnerable populations, including women and children, are expected to be hardest hit. To mitigate the crisis, experts are calling for immediate government intervention to improve agricultural infrastructure, provide subsidies for farmers, and enhance supply chain logistics. Additionally, international aid and partnerships may be necessary to address the needs of those most at risk. The potential for a hunger crisis on such a scale highlights the urgent need for both policy and community-level action to ensure that millions of Nigerians do not face severe food shortages. The looming hunger crisis could also have a profound impact on Nigeria's socio-economic stability. As hunger levels rise, so too could incidents of social unrest, putting additional pressure on the government to find effective solutions. Addressing the root causes of food insecurity is essential not only for the health and well-being of millions but also for maintaining stability in the country. From fluctuating gold prices shaped by U.S. economic policy to record Forex turnovers and dire hunger forecasts, the global and local economic landscapes are evolving rapidly. These developments have profound implications, not just for investors and policymakers, but for everyday citizens navigating an increasingly complex world. As financial markets respond to political changes, and as economies like China continue to struggle despite aggressive stimulus, it is crucial for individuals and businesses to stay informed. If you found this coverage insightful, please subscribe, like, and share for more updates and in-depth analysis of the global financial landscape. Stay informed, stay ahead, and be part of the conversation that shapes our world.